bonds catch a bid as poor macro data from the US and China brings back growth concerns. Equities find a short-term bottom as volatility and skew fall, and sentiment hits rock bottom. All this and more in this week's Macro Insight. To Macro Insight, everyone. Today is the 17th of May, and let's have a look at these markets. So, what did we see last week? Growth concerns came back. So, we saw equities rolling over, as they have been for a while, on the back of higher yields. But finally, it was really the growth concerns that were taking the lead. Equities really starting to break down below key levels, that 4,000 area on the S&P. And once that happened, then bonds actually caught a bit of a bid. So for the first time in a long time, we actually saw bonds up on the week. Yeah, we remember this graphic that I like to share that shows all of the standard deviation adjusted moves. Normally we get all the blue bars on the left-hand side because rates just keep going higher and higher and higher. Finally, we can see a load of blue on the other side with markets actually down. In terms of the worst sort of rates markets that yields down the most, we saw UK and New Zealand leading the way there, both on 10-year and 2-year. And US rates also lower as kind of hike expectations getting taken down a little bit, not crazy amounts, but a little bit, with inflation break-evens coming off as well. You can see US inflation break-evens down about 1 to 1.5 standard deviations there. Equities were a bit mixed. China and Europe were actually small up. And then you had US, Japan, and India lower. Obviously, US tech being particularly hard hit still. In FX space, dollar obviously still remained well bid against everything but the yen for a change, because the yen was benefiting from that bid to bonds, basically, right? It seemed very strong correlation right now between dollar yen and what 10-year treasuries are doing, right? So you saw the yen catch a bit of a bid there for once. And then commodities remained under pressure, particularly with metals on weaker Chinese demand outlook and things like that. But then you had crude and wheat holding in there, basically, right? Still supply constraints, supply issues there are still overwhelming anything else right now. And then finally, obviously, we all know crypto took a beating as the whole Terra Luna debacle sent shockwaves through what is still a fledgling asset class, right? It's been around long enough for a fair amount of money to be in it now, but compared to every other asset class, it's pretty fledgling. And you could argue that there's a lot of experimentation still going on in there. So these type of failures are just going to be run of the mill, but we'll talk more about crypto later. Okay. So then, the big data point that was really in midweek that the market had its eyes on was the CPI. And, whilst the year-on-year headline looked okay, looking a bit more closely at the data, you look at month on month as opposed to year on year, which has got base effects, then you're starting to see, CPI actually coming in at 0.6 month on month, which was above all the expectations. And then core services rose at 0.7 month on month, which was the fastest pace in that since 1990. Okay, and that's really what kind of got the market a little bit concerned and a bit spooked there. That the inflation momentum, short-term inflation momentum, was actually still very much there. Yeah. Let me share this chart from our friend Macro Alf. So he's done a good job on his latest Substack on the macro compass there. So you can see that US energy services inflation accelerating at a ridiculously fast pace. And then in the chart below, you've kind of got the contribution to CPI. So of particular interest is the shelter inflation, right? Which is, I've been flagging for months, right? That was going to be, there was a major risk that was going to be more persistent, right? Because that's a lagging measure and the house prices had exploded, you're going to see rent and shelter prices going up, and that was going to make inflation more persistent. And we're definitely seeing that in the white line which has been, going up at a pretty consistent pace there. So even though, as you're seeing some other things like used cars coming down, that more stickier part, those stickier components in inflation are holding up basically, right? And that's really the problem that the Fed's got, okay? And, that's another reason why the Fed needs to kind of slow the housing market down, right? Because we've been talking about this negative wealth effect that is going to reduce demand and reduce inflation. And, a large percentage of people's wealth is in their house prices, right? So if they can take the steam out of the housing market and bring that negative, that reverse wealth effect to bring demand and inflation down, they're also going to have the secondary effect of that lagged shelter inflation coming down later down the line in terms of longer run inflation expectations, right? So there's definitely a lot of incentive for them to take that housing market a bit lower, which in theory they've got the tools to do. They might struggle to get wheat prices and oil prices significantly lower, but house prices they can have a stronger impact on, and it's likely they will. That's what they're going to go after. And then whilst it's likely that inflation has peaked, the pace of that decline may not be as rapid as hoped for, right? Which may require even more aggression from the Fed at a time where growth is slowing. And this is something that Jim Bianco talks about a lot, that even if we have technically peaked, how fast is this stuff going to come down? And that's really what matters. Okay, so that was CPI. And then over the weekend, we got some more data. We've got Chinese data come out, pretty disappointing. It doesn't come as a major shock that Chinese data is bad right now, but it actually, blew through expectations to the downside. So if we bring up this chart here, you can see retail sales, industrial production, all rolling over in negative territory, and that's some pretty steep declines, right? Now, what have we been saying? Obviously, we know the zero COVID policy is the big driver here and the big reason behind this weakness. Lockdowns in major cities are never going to help. But, the fact that it's surprising to the downside is interesting. Talk of stimulus in China has been supporting stock prices lately, right? So stocks had a little bounce in China, but we're yet to actually see any real easing other than just rhetoric and talk about easing, right? So it's likely, and this is something Darius has mentioned, Darius Dale at 42 Macro, that they may well be waiting to come out of lockdowns before any stimulus packages, are announced or actually, implemented, because what's the point in stimulating while everyone's locked down, right? So you've also got some timing later in the year around the CPC Congress, where Xi is likely to, get elected for a third term. That's coming sometime in the second half of the year. So, you need to watch China carefully, because there may well be a really good setup here where they come out of lockdown, they stimulate, they want to look good for this, re-election term, this re-election of Xi, and that might be the kind of the bid that really we see in China that has been elusive for quite some time, right? So I'm watching on 42 Macro Signal. Darius has mentioned quite a few times that he looks at this SHIBOR rate as a real sign of easing in that market. And if we see that SHIBOR rate come down by a couple of, 1 to 200 basis points, then we could see the red line, which is the credit impulse, actually have a proper rally. And that usually leads the market basically, right? So that's what we should be looking out for. I'm pretty sure there'll be some, cool spread type trades that will be available there. Once we think that moves on, we'll get half decent leverage to that move basically. So that's what I'll be looking out for in China. Yeah, leaning on some of Alf's research again, because he's done some good work in the last week or two. He's basically put out a nice tweet thread talking about how he values the equity risk premium. Okay, so that, it is a way to determine whether stocks have sold off enough, right? So since the start of the year, we've obviously taken stock multiples down to reflect the worsening earnings outlook, withdrawal of liquidity from central banks. But have we done enough? So the way Alf looks at it, and the way a lot of people look at it, but this is his specific numbers that he uses, he looks at the 12-month forward earnings versus, so he looks at the earnings yield 12 months forward versus the 5-year real interest rates and compares those, right? And then he plots that. And basically what he says is, that's quite stationary. It's cheap when the risk premium's up here above 6.5, and it's expensive when it's below 4.5, basically. And right now we happen to be sitting right in the middle at 5.3. So the argument is that, you can't just look at equities in a silo and say, okay, multiples have come down and stocks have sold off, they're cheap now. You have to compare them to the risk-free alternative. And the risk-free alternative is real rates, okay? So because real rates have moved so much, they went from -1 to almost +0.5, that's a 3 standard deviation move in real rates. You have to then say, okay, well then how does that compare to what equities have done? And the idea being that to get this orange line up to the cheap, to up to 6.5 or higher, you'd probably need to see S&P down to somewhere like 3,200 to 3,500 before it really starts to look cheap, right? So that's what that type of valuation measure would suggest, basically. And funnily enough, that lines up pretty well with some of the other price targets on the street, right? So you've got the likes of Wilson at Morgan Stanley, who's been an uber bear. His target somewhere around there, around 3,200. You got Michael Hartnett at Bank of America. He's probably the most bearish strategist on the street. He's looking at around 3,000 as a sort of worst case. And then even Darius has done his own targets that are kind of somewhere in that sort of 32 to 3,500 area, basically, right? So we've got quite a few different people who look at different things saying the same thing about where S&P could get to on the downside, basically, right? So that seems to be a quite sensible sort of target zone. And then funnily enough, all these bearish people all agree that in the short term, things look really quite oversold, right? So a bear market squeeze, which we are used to getting, is becoming the most probable outcome for the next couple of weeks, maybe, because things have just got beaten up so much and sentiment has got so poor. And that leads me on to my next chart, which is sentiment, but it's not just investor sentiment, right? If you look at every little corner of the market, you've got consumer sentiment. Michigan confidence came out. Michigan sentiment came out on Friday. It's rock bottom, recessionary levels, right? Often a good leading indicator of recessions to come. The bottom chart, this chart was out on Twitter by Lynn Alden. She was referring to this chart. And just showing, when we get those red bars, that's when GDP turns negative and we go into recession. And usually this is quite a good leading indicator. When you get a steep drop in consumer sentiment, that's often a leading indicator into recession, right? Then the chart on the right, you've got small business optimism. That index is getting crushed. So businesses sentiment is horrible. Then at the bottom, you've got the two sort of investor sentiment indicators, right? That look at various measures. You've got a Bernstein one that's giving a buy signal saying, very, very bearish sentiment. And you've got the Goldman Sachs one as well with a negative 2.5 standard deviation. So all of these things are suggesting positioning is very stretched and very light. And sentiment is rock bottom, right? We're chopping around near that 40, 50, 4,000 area. That was kind of the battleground. It broke post the CPI numbers, accelerated into these lows of 38.55. That happened to be the kind of down 20% from the highs, technical bear market territory for the S&P. And then it staged a nice strong bounce off there back towards this sort of 4,000 area again. Yeah. What triggered that rally? A little bit of optimism that China COVID policy is working and they're going to kind of be releasing restrictions by early June, I think is kind of the timing that they're playing with now. And then Fed speakers, like I said, saying that they may pause the hikes to evaluate policy after the next couple of 50 bip hikes, right? And 75 was kind of taken off the table. So that's where we're seeing this sort of slightly more positive price action. And like I said, things were coming from very oversold levels. If we look at, the NASDAQ, that hit quite a key level of support on a longer term chart. So mapped out a few support zones here on the NASDAQ, and it literally taps the first one and bounces straight off it in this kind of 11,700 area, basically. But there's some pretty big ones lower down, 10,700, another 1,000 points, and then around 9,000. I don't know if we're going to get there, but these are the sort of, if you zoom out, these are sort of really long-term supports on NASDAQ that may present some sort of buying opportunities at some point in the future. Yeah. If we look at the S&P and see kind of similar story, on S&P, I've got 3,800. We got a bit short. We didn't quite get there. Then we got 3,550 and we got 3,200. These are all based on Fibonacci confluence zones, which I like to look at. If we look at the short-term chart on S&P, just to see where this rally could run out of steam, doing a similar sort of analysis on the upside. We're getting, resistances now that we've kind of broken out of this latest range, this sort of top at around 40.40 that we were making. We've got upside to maybe 41.35 as the first resistance, and then we've got another one at 41.95. Right, so though for me, those will be nice areas to start to reinitiate any shorts that you've taken off. I've been running some put spreads on S&P. I had bought some just delta against them because I thought we were oversold. I'm going to be letting that stuff go if we approach those levels. Basically, that's my game plan. So I've been running a trailing stop on those longs that I've got into. But if we do get to these levels, then I'll be taking those longs off and probably adding to my put spreads. That's kind of how I'm playing it on the short side. Okay, so that's kind of price action in US equities. As I mentioned, Europe and China were kind of outperforming a bit last week. If we look at the sort of volatility space and what that's been telling us, that was really where the big tell kind of was, right? And I mentioned this on the Discord group last week, I think on Thursday night when we were talking about it. So you've basically had this big volatility divergence where S&P, if we compare it to kind of March, S&P was a good more than 200 points lower, basically. So it was making, much lower lows on S&P. That's the candle chart. And then the VIX is the green line, was getting nowhere near the highs made in March, basically, right? So it really was struggling to perform as the S&P was coming down, and I suspected by breaking 4,000 on the S&P, we would get a pop in VIX and we might actually even see a 40 level, and that just didn't happen. That coupled with, index skew on the S&P getting crushed. So that's the dark blue line. This is a chart out by Goldman's where they compare S&P 25 delta skew normalized by the at the money vol. They compare that to the average of the Euro stocks, Nikkei and EEM, and also the average of the S&P constituents of the single stocks. And basically what it's showing is on a relative basis, S&P skew got annihilated, right? Just a really, really big sharp drop in S&P skew, which basically suggested that as the market was making new lows, there was just absolutely no panic to buy downside, right? If anything, dealers were just going towards long strikes, right? Or they were long too much vol, and they needed to basically lighten up the theta by selling downside, right? Or clients were selling it to them, whatever it is. There's probably a combination of a lot of these things. Like my working theory was that we had clients who bought put spreads, and we were likely heading towards the client's short put, and therefore the dealers long put as we were getting below 4,000. So the dealers weren't as short as you might have thought they were based on like the simplistic gamma exposure models that just assume all puts are short and all calls are long. Sometimes clients buy a put and sell a put, and therefore depends on exactly where you are. So I suspected that the price action in implied vols was basically because dealers weren't as short as we thought they were. Okay, you've obviously got this big 400 strike on SPY, 4,000 strike on S&P at the moment. Seems like quite a lot of gamma is on that. So now, like I say, I don't think dealers are as short as the models suggest because of the price action involved, but they probably are still short some, right? And therefore, if they are, then if we can stay above 4,000, then all those puts to the downside from 4,000 down to 3,800, those are going to be decaying, and those are going to be creating charm flows that are going to make the market makers need to buy delta, right? So in theory, yes, this could still act as a bit of a supporting force into this Friday's expiry. So that should kind of help us kind of drift higher towards that 41.50 area that I've kind of mapped out. Yeah. And then the only other thing is what the hero's been up to. And really that's just from yesterday's flows showing you what was going on. And there was no convincing bid in the option space, right? So no one really chasing the rally, no one really buying calls. If anything, we're seeing negative delta flows in the option space. We saw some call selling earlier in the day. And then as the day went on, we got some put buying basically, right? So people in options, certainly in the options flows that we're seeing in S&P, people kind of using the uptick in the market to get bearish again, using in options flow. Yeah. So that's kind of what we're seeing. And that's, I guess that kind of backs up our idea that that the rally is going to be relatively short-lived, and it's probably a selling opportunity, right? But now it does seem to me that the dollar's kind of ready for a bit of a pause here. And I flagged out to subscribers this morning that I took some more profit on my options or FX options. So I've been as you guys know, I've had some dollar yen calls, I've had some euro puts. I'd already taken a third of them off. I took another third off this morning, which actually, touch wood, seems to have been quite a good trade. So you can see, and the logic behind why I did that, right? So obviously I thought we were going to get a bit of a risk on in markets. So that typically, when we get risk on in markets, we typically get a pullback in the dollar. There's that negative correlation. But also, if you just look at the dollar chart, you know, we made higher highs from that initial touch of 104 up to 105. But look at what the momentum's been doing, been collapsing, right? So rather than shorting the dollar when we first touched 104 a week ago or 2 weeks ago, I said the momentum's too strong right now, so it's not as obvious to short it here. So I'd rather wait to see higher highs, but on weaker momentum. And then that is, now I'm not going short the dollar, but I'm just using that as a signal to take some more profit on the dollar, basically. My call options don't expire till end of September. So I'm still happy to keep some of them on, but it just seemed like a bit of a no-brainer to take some off here because we were quite likely to get a bit of a pullback, right? And that seems to be happening right now. You know, another reason to think maybe we would get a pullback was just because, you know, ECB have been making more noises. You know, euro got pretty beaten up down to that 103 and a half area. And, you know, Villeroy, the governing council member, was out warning that they needed to keep an eye on the euro due to, you know, if the lower it goes, the worse that is for inflation, basically, in the euro area. And then the market seems to be kind of getting its head around the idea that QE is ending in July, and then rate hikes are coming maybe in September or something like that. So at the margin, there was room for maybe the ECB to get more hawkish in their talk, whilst the Fed already reached max hawkish and was starting to turn a bit the other way, right? So that just in the short term, there was a bit of room to maybe get a bounce in euro, and we seem to have had that bounce back above 105s. Nothing too exciting, right? But, you know, for now, I'm glad I took a little bit more profit on those puts, and then I'll see if there's an entry point. If we get all the way back up to 108 near there, that's probably a good entry point to reshort it again, basically. But I'll see what happens when that comes. Yeah. Now there is also a debate, and this is something that, again, Alf and Andreas on the Macro Trading Floor podcast were talking about. If you haven't watched that, you've got to watch it. It's amazing, right? These guys bring on macro guests. They give actionable trade ideas. It's just very, very informative, and the way they present it is great. You know, the thing that they were saying was, and this is Andreas, I believe, he's quite bullish on the dollar still, even though, you know, I'm saying short term, I think it pulls back. I think he's a bit more medium term. He's bullish on the dollar. What they're basically saying is, even if they start, you know, hiking rates and ending QE in Europe, peripheral bond spreads are going to blow out. We're already starting to see Italian BTPs versus Bunds blowing out to like 185 or something. And the idea is that they think that could go further, maybe to 250. And as those spreads blow out, that typically undermines the euro, basically, right? Because these peripheral, like Italy, Spain, Portugal, etc., they're not in a good spot, basically, right, in terms of their debt. And as those peripheral spreads blow out, then people get more concerned and don't feel comfortable investing in Europe, and euro comes off again, basically, right? So euro's kind of capped, even if they start to get more hawkish, because that is not going to do wonders for sovereign credit in Europe, basically. That's the ideal. So threading the needle for ECB policymakers looks even harder than it does for the Fed, right? That's the argument. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.